Jonathan York from Bay Financial Partners, looking at the investment markets. Sort of quite interesting at present, with markets seem to be getting a little bit sort of out of kilter with what's being said and also the data coming through as well. Oil is hovering around that sort of $60 a barrel, and it's just going to be interesting now over the next sort of 2 to 3 months to see how these year-on-year inflation data starts to come through, not just here in New Zealand but globally. Because it was about a year ago that oil started to fall, and it's just going to be interesting to see when those big falls are starting to drop out of the index, how the actual year-on-year inflation data starts to come through. Also interesting in the US, you look at the forward data and forward implied interest rates. On the futures, Fed funds are implied to be around sort of 1% by year end, whereas the Fed is still sort of looking and sort of talking about a rate of around sort of 1.8 to 1.9. So that's obviously quite a divergence. It's going to be very interesting to see which one is correct and how the market sort of adjusts accordingly. But at present, equities sort of seem to be holding a reasonably sort of good bid. Earnings data was okay-ish. It wasn't spectacular, but it was okay. And it's now just going interesting to see how they trade over the summer period in the Northern Hemisphere. Obviously, that's going to be majorly impacted by how the Greece scenario works out. Still sort of a bit of a standoff at present. And it's still really sort of inconceivable to see how Greece is going to leave the euro and the euro to stay intact, given that other parties could then look at it and say, well, actually, and although there are contingency plans being drawn up, most expect that Greece will stay in the euro because probably Greece needs the euro probably slightly more than the euro needs Greece. Here in New Zealand, obviously, there's been quite a bit of talk in recent weeks about the possibility of a cut in the June Reserve Bank meeting, which is on the 11th of June. And it's just going to be very interesting to see how that does pan out, because traditionally central banks haven't sort of announced that potentially there could be a cut in rates, then the next meeting there is a cut in rates or a move in rates, unless it's exceptional circumstances like the Christchurch earthquake. If you look at the last meeting, there was talk that if economic conditions do weaken, then there is a possibility for a cut in interest rates. Well, that's pretty much common sense. But certainly at the moment, the rationale for the cut haven't been met really. Inflation is still not really very exceptionally low, but also the economy hasn't weakened substantially enough to warrant a cut in rates. And traditionally, what would happen is that the Reserve Bank or a central bank would start to talk about this, and then maybe 2 or 3 or 4 meetings later, you would then start to see the move. You wouldn't just see it talked about at one meeting and a move the following meeting. So really it does seem unlikely you're going to see a cut in interest rates, and that's going to be interesting because certainly the interest rate market and bond market here in New Zealand's got pretty excited about it and has already started to sort of price in that sort of move going forward. And if it doesn't happen in June, and really I just can't see it happening, it will be very interesting to see the price action going forward. Still quite a bit of interest to say in the high dividend shares. Certainly when you look at interest rates, and if there is talk about a cut in interest rates, and that starts to impact on the pricing of term deposits. And some of these high dividend shares, I say there's pretty good demand out there, and there's a pretty reasonable case for holding them. So if you're interested in that, call us on 0800 867 323. Or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we'll look forward to speaking to you soon.